We have held, so the next category we're talking about is held to maturity. Okay, so what we're talking about, that'll be debt, of course. All right, and the reason it's debt is the fact that, of course, the stock's not, doesn't have a maturity date. And of course, it'll be a current asset if it's due within a year. Okay, and of course it'll be non-current if it's more than a year. Okay, all right. And of course what you do in this thing, so just by way of review, let's take a look at exercise 15.1, page 617. Okay? And here's how it reads. Okay. So, take a look at this top one here. So what it says, prepare the journal entries to record the following transactions, okay, involving, I'll turn this around and let me, when you guys watch this at home, you'll be able to tell what we're talking about. So, excuse me. So, prepare the journal entries for the following transactions involving short-term security investments of the Maxwell Company, all of which occurred in 2011. On February 15th, they paid $100,000 cash to purchase FTR's 90-day short-term note securities, $100,000 principal, that paid 8% interest. It's codified as a held-to-maturity securities. Do I have a quick study? You'll see it'll work the same. Okay, it's held, let's just assume this is held to maturity. Okay. On May 16th, it received the check and paid with the principal of 90 days interest. Okay. You guys want to
Yeah.
A short-term note is like a bond. Yep. A bond would work the same way. So again, nothing surprising about this. Here's what it looks like when you buy it, right? And then here's what it looks like. Here's what it looks like when it's paid off. So what the deal is, when you buy it, you debit short-term investments, credit cash, and then when it's due, you held it to maturity. Then here's the principal that's returned. Here's the interest that you've earned, and the time together is how much cash you received. And that was held to maturity. It was short-term. Okay. And it's a short-term held to security maturity. Does that make sense? Okay, there's probably nothing surprising there. Doing good? All right. You guys are okay with that? Let's go on to the next category. So don't forget, now the next category, so while I have the light up, let's put that slide back up. So don't forget what we're dealing with here. Are we dealing with these categories? So in this case, what we have here now is, see, this goes here. Okay, this goes here. So what we've done now is, don't forget, there's these various categories of investments. Which category it's in determines how you work with it. So last time we talked about trading securities, and those are debt or non-influential securities. They're actively traded. If they tell you it's a trading security, the unrealized gains are reported in the income statement. Okay? Then we talked about held to maturity. That's the one we just did, and it's the amortized cost. So in this case, If you bought it you'd report it on your balance sheet at its present value. So if you bought it at a discount or a premium, you'd report it at you'd report it the carrying value at that point in time if it had one, okay? Now we're getting the next category, which is available for sale. So the available for sale is reported fair value just like the trading security. So everything we say about the available sale will apply to the trading security with one exception. The trading security unrealized gains and losses were reported on the income statement, right? Here, unrealized gains and losses are reported in a contra owner's equity account, or an adjunct to owner's equity account. They increase it, but it's reported as part of a change in owner's equity, okay? However, everything we say about it, with that one exception, will also apply to trading. We'll do some things with this that we didn't do in the trading. So, let's kind of go through some, so is everybody okay with that? Yeah, Addie?
It's a contra equity account?
Yeah, and again, the way it works is, if it has a debit balance, it's contra owner's equity, it decreases the total of your owner's equity. If it has a credit balance, it would be an adjunct, but it's the same, all it does is increase it.
Okay.
Okay? All right. Now, let me go ahead and kind of work through an example here. And then we'll have you practice this. Thank you very much. So let's get through here. So, let me move this back here. Move this here. So, these are available for sale. And available for sale, right? And so what it means is you have less than 20% holding in a company, so you don't have any, you're just seen as non-influential, right? So you have some money invested in it, you have less than 20% you own less than 20% of a company. Okay, so it's not influential. So here we go. In this case, let's put up kind of an example here. What we have is here's a company A. Here's the cost. In this case, the cost, you pay $30,000 for this stock. It's fair value, which is you got out the Wall Street. So what you did is you got out the Wall Street Journal and valued the same stock. And the fair value was $29,050. Okay. So if this is what it cost you, this is what it's valued. There was a loss of $950. Okay, and this would be the unrealized gain / loss. Okay, then you have company B, and you paid $43,000 for it, and its current values is $45,500. That meant there's a gain of $2,500. That meant your total cost is $73,000. Your total fair market value is $74,550. That meant your total gain is $1,550. Does that make sense? Now, what this is an adjusting entry because you own these stocks, you bought them, the end of the accounting period arrived, you opened up the Wall Street Journal, found out this is the fair value, this is your whole portfolio, so the total cost is $73,000, the total fair value is $74,500, and this is an unrealized gain. And you own them, you haven't sold them, right? If you sell them, realized gain. That's not what we're talking about here, okay? So, the adjusting entry, we'll make it December 31, I'll put 80 adjusting. What you do is fair value adjustment. This is December 31. Fair value adjustment. Will be debited for $1,550. And then you have unrealized gain. And it will be credited for $1,550. So this goes to your balance sheet to increase the value of your assets. So this is what your asset is. The cost, it will increase by $1,550, and the current fair value will be $74,550. Okay? This will show up on your balance sheet. It will show up as a owner's equity account, and it will increase the total value of your owner's equity by $1,550. Okay? If it was a trading security, everything would be exactly the same, except this unrealized gain would go to the income statement. And yeah,
Fair value adjustment on the balance sheet goes where?
well, let me show you actually. So here we have the balance sheet. Okay? And we have long-term investment, and so what we'll do is, in this case, it'll be under the asset section. We'll have a long-term investment. And the cost was $73,000. Fair value adjustment. Will be $1,550. That meant the long-term investments at fair value will be $74,550. Okay, does that make sense? And then in your equity, the equity section, so this is the asset section, the equity section, you'll have add realized, you'd add the unrealized gain to your equity section of $1,550. Okay, so this will show up as part of your equity, and it'll increase it, right? And this will show up as a contra asset, and will increase it. Does that sound pretty good? Now, let's do one more thing. Let's do this as a T account. So the other thing important to realize is, you know how you had, by the way, guys, is everything readable here? You didn't want me to, you doing okay? Too small, too low? Too low, okay. I think if I put everything in the same board under the same topic, it'll work better, and yeah, it is kind of low. But anybody want me to read anything or anything? Good, all right. So let's do this. Now don't forget, this unrealized gain, right here, this fair value adjustment, that's a permanent asset account. You know how accumulated depreciation is a permanent account, right? Because the end of the accounting period arrives, it retains its value, it rolls into the next accounting period. Now with increase, we have more depreciation, right? This works the same way, it rolls into the next accounting period. So if I point out that this is a permanent account, then much of what happens after this makes more sense. Okay, both of these are permanent accounts. Okay, so both of this and this are permanent accounts. Yeah, Addie?
Would the short term then be permanent as well?
Yeah. Yeah. Yep. All right, now, let's do this as a T account. So here's what we have as a T account. So we'll have unrealized gain equity. All right, and it will have a credit of $1,550. Okay, and that's this one right here. Does that make sense? And we'll also have a fair value adjustment. Okay. All right, and it will have a debit of $1,550, and that's this right here. So I'm going to get a different color marker. So this fair value adjustment, this debit goes here, and this credit went there. Does that make sense? Okay. Now, the end of the next fiscal year arrives, and you revalue your portfolio, and it turns out that the value of the portfolio at the end of the next accounting period is so. So this is December 31st, 2010. December 31st, 2011, what you got here is the cost, the fair value of your portfolio is 82,000. The cost is 81,000. That meant there was a $1,000 gain. Okay? Does that make sense?
Yeah.
So this is year one, this is year two, we're going to do an adjusting entry. Does that make sense? And now, what wasn't pointed out here is all of these stocks may have been sold and they may be replaced, but it's your stock portfolio, okay? Now, what happens on this thing is, so now what we want to do is we want this thing to have a $1,000 balance. So this is 2010, both of these are, and now we want both of these to have a $1,000 balance. Does that make sense? And mainly because these are permanent accounts, and so what we want is we want this to read cost. This will be the new adjustment, and this will give the 82,000. Does that make sense? Are you okay with that? All right. So if this has 1,550 now, we want it to have 1,000. What's the adjusting entry? Sure, this has to be credited by 550, and this is the adjustment. And this is 2011. This has to be debited by 550, and that's the 2011 adjustment. So the journal entry for that then will be, this is December 31st, 2011, so the journal entry for that will be, all right, December 31, this is 2011. It will be unrealized gain, we debited 550, and fair value adjustment will be credited 550. So I hope, so what we've done here now is the fact that your portfolio will be reported at cost. You have an adjustment that will bring it up to its current fair value. Both of these are permanent accounts, right? And so in the next year, you want a $1,000 balance. And so to change that from this 1,550 credit to this 1,000 credit requires you to debit it by that amount. Does that make sense? And the only reason this works this way is because both of these are permanent accounts. And because they're permanent accounts, they need to be, they have to report an amount that will bring it up to its current value. Does that sound, yeah?
So if the account name is unrealized gain, is there another separate account that's unrealized loss?
Yeah.
Or is it the same account?
No, it'll be so in this case, it's an unrealized gain that's debited. Yeah.
So
Often what you have is you have an sometimes you have an account called unrealized gain / loss. Such that if it has a debit balance, it'll show up as a loss, but as a credit balance, it'll show up as a gain. Often you have an unrealized gain and an unrealized loss, and you work between the two. In fact, that's what happens, and I'm glad you asked, because let me do exercise 1510, page 618, and it'll have that. And that's the reason I thought I'd do it, because it was different. So let me check in with you guys. Jacob, how you doing back there? Doing good? Yeah. You doing good? All right, Michael, you're always a good lightning rod. You doing good? Appreciate any questions?
I'm looking at the side notes on this one on page 601.
Okay.
And you're just touching on it, but it's saying about how, okay, if the cost was 83, and the fair value is 82, so there's $1,000 adjustment that we're talking about.
Right.
But here it's calling it an unrealized loss in equity. Why
I
would
think,
it
I think that sidebar, I think it refers to the fact that there's a reversal there. Actually,
be, it's calling it a loss, because it's showing, and the gain of 1550 to get the reconciliation, but I'm just wondering, why is it calling it that?
let's just take a look. Right, in other words, the losses, let's take a look here, example. Oh, this is this goes in reverse. In this case, it should, still is a gain, but it's a smaller, This is saying,
Had it been
yeah,
lost, so
here,
this is just a
exactly.
separate example.
Yeah,
Okay.
and in fact, what I'll do is, let me show you an example of what you're describing here. So if you ignore that, this will do the same thing. This will demonstrate what you're doing there. Okay? All right. So listen, let's do this. Okay? So let me do exercise 1510, page 618. All right. So, here's the problem. Let me read it to you guys, and then I'll do it, and, sure, I'll be with you just for a second. Let me just kind of do this. All right. And why don't I go ahead and do it on the board? Let me turn the camera around. Okay, and I'll just, okay. And by the way, you guys, be sure to give me your attention. Okay. All right, so let me go ahead and put it up there. So here's the way this works. So in this case, here's the way this works. It's a little bit complicated. So what we have here now, exercise 1510. So in this case, let's do some computations first. Now, let me make this smaller so I'll make it. Okay. All right. So, by the way, Antonio, could you reach around and close that line behind you there? If you reach straight, there you go. Thanks. All right, so here we have the cost, fair value. So here we have 12/31, 2010. Now, we're dealing with these two numbers here. So the cost was 79,481, the fair value is 72,556. Okay. That difference is a loss of 6,927. Okay? Then, on 12/31/2011, the cost of the portfolio at that point in time is 85,120. The fair value is 90,271. That gives you a gain of 5,151. Does that make sense? So here, the cost is greater than the fair value, so there's a loss. Here, the cost is less than the fair value of the gain. What they want you to do is they want you to record the adjusting entry for this year. Okay? So, the way this works is, what will happen here is, and let me put it up here in T accounts, because I think it may be kind of easier to see how this thing works out. Okay, so, in 2010, what we had, so this is the unrealized loss. Here we have unrealized gain. We won't do anything with this for the moment. And here we have the fair value adjustment. Now, in 2010, which is this year right here, what we had was, we had an unrealized loss of $6,927. We had a fair value adjustment of $6,927. Okay, and that took care of this. Does that make sense how that worked out? Now, in 2011, we want a gain of 5,151. So we want a 5,151 here. So what this means is that we have to credit our loss to zero, okay, of 6,927. Okay, we want to credit our gain of 5,151. That means we have to debit our fair value by 12,078. And so this is 2011, that's 2011. Where we came up with this number is we need to zero out the loss of 6,927. We need to establish the gain of 5,151. So those two together is 12,078. So what we'll do is, in this case, and this is following up with Addie's question, is that now they have an unrealized loss, they have an unrealized gain, and they have a fair value adjustment. So this is the contra owner's equity. These are the two. This is the contra asset. These two are owner's equity accounts. We had a debit and an unrealized loss in the first year. We want to establish a gain, a credit and our unrealized gain for the second year. So to do that, we need to zero out our loss, establish our gain, and so these are the two credits. This is the debit. Does that make sense? How that all fits together? And Addie, you're the person who asked the question. Is that making sense? I don't mean to put you on the spot. I'll be right with you, Brandon. It's not. Is it helpful if I put this up?
Yeah.
Okay, and again, these pencil marks are just notes to myself.
Yeah.
Tim?
It almost seems backwards to me, the unrealized loss and unrealized gain.
Why would that seem, I'm not sure if you mean it's backwards.
Because in December 31st, 2011, I thought we had a loss of 51.51.
No, so here's 2011, so here's what we paid, here's its value, it increased from this to that.
Oh, okay, I had my notes backwards, that's what
And what this does is this takes this and puts it in a different format. Just rotates it 90 degrees.
totally makes sense.
Yeah, Gene?
So why exactly is the fair value adjustment total, or the 12,070?
See if this is helpful. Don't forget, this fair value adjustment is a permanent asset account, right? Now it's a contra asset. And so you want to change its value from this to that.
Oh, okay.
And to do it, it takes this debit. And then this debit equals these two credits. Yeah.
What I'm confused about is why are you doing it for 2 years? Like, why didn't they do this at the end of 2010 and then again at the end of 2011?
They just, the problem only asked for the last year. Yeah, but you're right, it could have asked for 2 years. And had it asked for 2 years, then it just asked for the second year's all.
No, but why does it give you 2 years of information?
Because you need to know how much is in the account for starting.
Yeah,
I'm sure.
exactly. So what it does is it gives you the balance that you need to adjust. Without that balance, you couldn't figure out the adjustment.
It was asking for the change in the account, like the total change, you're not trying to, okay.
In other words, a good way to word it. Eddie, I don't mean to put you in the spot, but I see a quizzical look and you really got good questions. You and Michael are good questioners. Did you hand up, Michael, or? All right, yeah, Tim?
So, is that gonna be in the contra asset account that, the previous years?
It would have been on last year's, it would have been last year's.
Contra asset.
Yeah. But again, the reason they put in the 2 years, of course, is because you need to know the current balance to know how to make, you know what I mean? You need to know the balance at the beginning of the year, which is the end of last year, to know how much of a change to make. Yeah, Michael?
What would be wrong with, because you know you're looking for the difference between the two also. And so why wouldn't you just say, okay, here's the unrealized gain or loss by taking the difference between the 2000.
By the way, Nathan and Eddie, did you guys maybe join the class and answer any questions? But let me wind up with Michael. Jesse was next, and then you guys all would deal with it? Yeah.
I was thinking that you could actually take the loss from 2010
Okay.
plus the gain from 2011.
Mhm.
The difference in that could be your adjustment as well, wouldn't it?
Well, don't forget, one's a debit and one's a credit.
But I mean, if it's saying, based on 2011, the adjusting entry would reflect any fair market or fair value adjustment for these investments. I'm only looking at these two investments. Aren't I looking for the gain or loss between the two?
Well,
Not necessarily.
I think what's more to the point is, this is what the balance is at the beginning of the year. This is what the balance has to be at the end of the year. How do I move from this to that?
So you're starting with a negative and you end with a positive.
Exactly, that's, you're
That's why
starting
you
with a
add
negative and
together.
you're ending with a positive.
That's-
So it's not really the difference, you just move from a negative, it's not a difference per se, but rather it's negative to positive. And that means you gotta wipe out the negative and establish the positive, you wanna word it in those terms. Another way of saying it is, you got this, you have this, yeah, yeah. What you got is you have this debit, you have this credit, which is a contra asset. You wanna move to this debit, it requires that debit. This to that requires that.
It
Now-
seems a long way around the horn.
It's just the way the accounting works, because it deals in terms of debits and credits. And if you want to turn, yeah. Now, let's see, Jesse, you had,
That answers my
Hey,
question.
and-
My question was, why do you add the two together?
yeah, because you went with that.
Even though one is
Yeah.
negative, that's one.
Now you guys are up.
Well, this, I already got the one answer, but, so the unrealized loss and unrealized gain, those need to total zero into the fair value. So it's almost like a number line. You want to reach 515 from this loss, and you're
Exactly.
moving up this amount to get to that. But those two accounts, they're zeroed out at whatever they say, or?
No, they're not zeroed out. What you're doing is this debit in unrealized loss is what shows up at the beginning of the year. You want this credit unrealized gain to replace it.
Okay,
So you zero out the loss, establish the gain.
okay.
Now, that's the equity. Under the asset section, you have this debit balance, this credit balance, right? You want to establish this debit balance, and so it requires this debit entry. And by the way, what don't forget, everything we say now also applies to trading securities. Although we didn't do it at the time, but it all applies. Maybe you get an answer to your question, okay?
Yeah, I was just explaining that it's the change, the 12,000 is the change from the
Exactly.
beginning balance to the end.
Sure, sounds good. Let's do this. Let me do quick study 15-4, and that'll be a sale. So don't forget, unrealized gains and losses, realized gains and losses are independent of each other. Okay? So, now, let me do quick study 15-4. All right. So here's how it looks. So what we have here. All right. You guys ready? Okay. All right, so what we have here is, so the vendor company purchases short-term investments available for sale securities at a cost of $100,000. Okay? On November 25th, 2011, December 31, 2011, these securities had a fair value of 94, so they lost 6,000. This is in the first and only time the companies purchased such securities. Okay, so that you don't have to take into account the previous balances we did in the previous one. So prepare the year-end adjusting entry. So the year-end adjusting entry will then look like this. Okay, so we have, this is 2011. Okay, this is December 31. We have an unrealized loss, equity, okay, and we have a fair value adjustment. And that will be for the $6,000. Okay, so this is the year-end adjusting entry. And what it does is it shows an unrealized loss in this case, and so this will be a contra owner's equity account, this will be a contra asset account. It will change the value from 100,000 down to 94. Is everybody okay with that?
What is that word after loss?
Equity.
Okay.
The equity. Okay. That makes sense? Now, the next thing they ask you is, Part 2, 15-4, for each account on the entry, explain how it is reported in financial statements. So the unrealized loss is reported as a reduction in the equity section, okay? And the credit balance, the fair value adjustment available for sale, is a contra asset account. It reduces the cost balance in short-term investments available for sale, okay? So this is a contra equity, contra asset. Okay, and both of these are recorded on the balance sheet. Now, the next thing is they sell, so what it is, on April 6, 2012, next year, they sell half of these accounts for $52,000. So when they do that, okay, I'll put that back up in a second. So when they do that, this is 2012, is the next year, it's April 6, cash is debited for $52,000, and your short-term investments is credited for $50,000 because you sold half of it. There's a plug figure of $2,000, and that will be a gain, okay, on sale, okay, of short term. I'm going to put up a printed copy. So what this says now is that the realized gains and losses are independent of previous unrealized gains and losses. So let me put this up here. Okay. So what it says is here you have an unrealized loss. Here you have a realized gain. When you have the realized gain, it does not take into account any previous unrealized gains or losses, is the point of this whole thing. Does that make sense? Yeah.
Is that because it will all balance out in the contra asset account?
Yeah, it's because in these things, there's a whole bunch of these, and they're bought and sold and bought and sold. They're not actively traded, they're not bought that frequently, but the way FASB said is, at the end of the year, report the value of your investments at fair market value. Then when you sell it, you sell it. And the two were just treated as being unrelated. Okay? In this case, there was an unrealized loss at the end of the year, and then 4 months later, 3 months later, you sold them at a gain. And this realized gain does not take into consideration your previous unrealized loss. They're just independent of each other.
Is it partially because of the cost principle? Because what you paid for it initially, that's what you have to kind of start from?
Yeah, that's exactly right. First of all, this one is based on the cost principle. That is true.
This was really confusing when I was doing the homework this point, so now I'm starting to understand.
Yeah, but again, what you gotta realize is the fact that realized gains and losses do not take into account unrealized, previous unrealized gains and losses. The fairest way to do it is to treat them independent of each other. Yeah,
So then, on December 31st, 2012, you would basically do an adjusting entry for the remaining funds that you still have.
that's exactly right. And both of these are permanent accounts. So you take this ending balance and you make an adjustment that would bring this $50,000 to fair value.
So I saved enough cash with a discount.
That wasn't me, was it? What was that?
You just saved a bunch on Geico.
You guys, that all makes sense.
Yeah.
Doing good?
With that,
All
I
right.
think we should take a break.
What's that?
With that, I think we should take a break.
I think so too. So you guys are doing good? All right. Well, by the way, we are at a good stopping place because now we're going to move into the next category of influential. So let's take a break here.